Welcome to The Explainer. If you're buying a home or you work in real estate, you've probably heard the acronym RESPA thrown around. It stands for the Real Estate Settlement Procedures Act, and honestly, it's a huge deal. So today, we're going to break down exactly what this law is, how it works, and most importantly, how it protects you from sneaky costs and unfair business practices. So let's start with the big why. Why does this law even exist? Well, this quote, pulled straight from the Act itself, says it all. Congress was targeting unnecessarily high settlement charges. Basically, they saw that homebuyers were getting slammed with surprise fees, and RESPA was designed to be the consumer's shield against those kinds of abusive practices. To really get it, we've got to wind the clock back to 1974. That's when Congress passed this thing to clean up what was, frankly, a messy home closing process. Back then, it was handled by HUD. That's the Department of Housing and Urban Development. But today, the main sheriff in town is the CFPB, the Consumer Financial Protection Bureau. Okay, so here's our game plan for this explainer. We'll start with the why, then get into the specific documents you're supposed to receive. We'll definitely spend some time on the absolute ban on kickbacks, then cover the rules for your escrow account and what rights you have even after closing. And we'll finish up with the must-knows for any pros studying for their license. Let's jump in. All right, first things first, let's dig a little deeper into RESPA's core mission. What exactly were the problems it was built to fix? The law actually spells out four main goals. Number one, give home buyers a clear heads up on closing costs and do it early. Number two, kill all the kickbacks and shady referral fees that just bloat the price tag. 3, stop lenders from hoarding too much of your money in escrow. And 4, a bit of a technical one, was to help modernize how land titles were recorded. So you might be wondering, who does this even apply to? Well, RESPA covers something called a federally related mortgage loan. Now that sounds complicated, but it's really just a huge net that catches almost every residential mortgage for 1 to 4 family property. If your lender is federally regulated, or the loan could eventually be sold to giants like Fannie Mae or Freddie Mac, you can bet RESPA applies. And what part of the process are we talking about? We're talking about settlement services. This is basically the whole shebang. Everything you need to do to finalize the deal. Things like getting title insurance, having an appraisal done, pulling credit reports, and even the work your real estate agent and loan officer do. Okay, moving right along to Section 2. Now, this is one of RESPA's superpowers, mandatory disclosures. The whole idea is simple but revolutionary. You have the right to know what you're getting into before you owe a single penny. So the law sets up this clear timeline of information. Within 3 business days of applying for a loan, you have to get a booklet explaining the process, and more importantly, a loan estimate with all your expected costs. But here's the absolute game changer. You have to get your final closing disclosure a full 3 business days before you sign on the dotted line. This isn't a suggestion, it's a mandatory review period designed to stop any last-minute sticker shock. Next up, we have to talk about Section 8. Honestly, this is probably the most famous part of RESPA, and it's also the part that gets violated the most. This is all about illegal payments, or, as they're better known, kickbacks. And the law couldn't be more direct here. It says you can't give or accept anything of value, and that could be cash, sports tickets, a fancy dinner, you name it, just for referring business. It's a total, flat-out ban on paying for leads, period. This slide really nails the difference. Paying someone just for sending a client your way, that's an illegal kickback. A title agent slipping a loan officer some cash for every deal. But paying someone for actual work they did, like a mortgage broker who took the time to process your entire application, that's a totally legitimate payment for services, and RESPA is perfectly fine with it. It's all about paying for work, not for referrals. All right, let's switch gears and talk about your money, specifically the money held in an escrow account for things like property taxes and insurance. RESPA has some really strict rules here to make sure lenders don't take advantage. The key number to burn into your brain here is 2. Lenders are only allowed to keep a maximum cushion of 2 months' worth of your escrow payments. That's it. This simple rule is huge because it prevents them from sitting on a giant pile of your cash unnecessarily. And to keep everybody honest, RESPA forces a yearly checkup on your escrow account. Your loan servicer has to run the numbers, send you a detailed statement, and here's the best part, if they find they've collected $50 or more than they needed, they have just 30 days to send that money right back to you. You might think RESPA's job is done once you get the keys, but nope. Its protections follow you long after you've moved in. Our fifth section is all about loan servicing. That's who you send your mortgage payments to, and you've got rights here too. It's super common for your loan to be sold, meaning you'll have to send your payment to a new company. When that happens, RESPA demands a smooth handoff. The old company has to send a goodbye letter 15 days before the switch, and the new one sends a hello letter within 15 days after. And crucially, you get a 60-day grace period. If you mess up and send your payment to the old place during that window, they cannot call it late. It's a great safety net. Okay, last but not least, what happens when someone breaks these rules? For anyone studying for a licensing exam or who just wants to know how powerful this law really is, this part is essential. Let me tell you, the penalties have some serious teeth. We're not talking about a slap on the wrist. A kickback violation under Section 8 can lead to a $10,000 fine and even jail time. If a seller illegally forces you to use their title company, they could be on the hook for 3 times what you paid. The message here is crystal clear. Don't mess with RESPA. And who's the main enforcer making sure all this happens? Well, that's the Consumer Financial Protection Bureau, the CFPB. They're the ones with the power to investigate companies, make new rules, and bring the hammer down when someone doesn't comply. So let's put this all together with a classic exam-style question. Say you have a real estate agent who also co-owns a mortgage company, and she sends all her clients there. This is what's called an affiliated business arrangement. To stay on the right side of the law, what's the absolute minimum she has to do? And here's the answer. It comes down to 3 things. 1, she has to give the client a written disclosure about the relationship, right when she makes the referral. 2, she absolutely cannot require the client to use her mortgage company. The client must be free to choose whoever they want. And 3, the only money she can make from that referral is her normal profit as a co-owner, not some special fee for each client she sends over. So if you walk away with just one thing from all this, let it be this. RESPA is all about mandatory transparency and basic fair play. It drags the whole confusing settlement process out into the daylight and shuts down the kind of backroom deals that only end up costing consumers more money. And that brings us to a final thought for you to chew on. RESPA was written almost 50 years ago, way before anyone was thinking about digital mortgages or iBuyers. So the big question now is, how do we make sure these fundamental principles of fairness and transparency keep protecting people in a world that's moving faster and more online than ever before? Thanks for joining this explainer.